Joining us right now is Kevin Hassett. He is the chairman of the Council of Economic Advisors, joining us from the White House. And Kevin, it's great to see you. Thank you for being here.
Good morning. It's great to be here.
Let's talk about the economy first up, because we got some very strong numbers on the jobs front last Friday.
When
we saw that the unemployment rate fell to almost the lowest level in 50 years.
I was 7 years old the last time it was that low. And I think that not only that, but there were upward revisions to August. Atlanta Fed's GDP now, pretty late in the quarter, really, or late in the quarter data-wise, is saying north of 4 for the third quarter. And so absolutely, we're looking at the positive response to President Trump's policies that we expected.
When you look across the economy, do you see any signs of weakness?
No, not within our economy. The thing that is starting to be worthy of note is that emerging markets are starting to show some stress. And I think the IMF put out a forecast that was a couple of tenths lower for global GDP. And I think that at CEA, our models concur with that. And so the rest of the world is looking a little bit weaker. Now that, politically is interesting, because one of the Democrats' main talking points is, the whole world's booming, and so therefore the U.S. booming is not President Trump's policies. I think the current trajectory suggests that there's some lie to that, really. But yeah, I'm very concerned about emerging markets. And if you look at the indices, you can see that they're heading in a way that's a little bit troubling.
Kevin, the IMF lowered its global growth forecast, but it also lowered its growth forecast for both the United States and China slightly because of concerns about the potential for a real trade war playing out over an extended period of time. Do you think their forecasts are correct in that front, too?
Well, I think that right now, we're looking at GDP growth of about 3.5% for this year and carrying on to something a little bit north of 3 next year. And I guess that's a little bit more optimistic than they are. I think we're all at the White House hopeful that talks can resume and that we can move to a positive place with China. But make no mistake, President Trump is serious about it, that if they don't, behave a little bit better, stop stealing our intellectual property, lower their tariffs on our products, then, this could continue longer.
The president made those comments yesterday about how inflation has not really shown up. And that's certainly true. We haven't seen it in a lot of the traditional places that we might measure it. But we are starting to see places where wages have increased slightly. And then you have just anecdotal evidence from companies like PPG, which issued a profit warning earlier this week on concerns not only of weaker demand in China and potentially in Europe and the U.S. for some cars, but also on higher prices, some of the biggest price increases that they've faced in a while. Do you see it popping up through the pipeline anywhere? Is this something you're tracking?
Yeah, I think that talking about whether inflation is popping up or something is I'm starting to get into the turf of the Fed, and we at the White House really do respect the independence of the Fed. And I think even what the president was saying last night, made that evident, where he said, he stays out of it, he doesn't browbeat Jay Powell or anything, but he thinks interest rates could do this or that. The fact is that the president's respect for the independence is clear in the quality of the people that we sent over there, and so anyway, I have to kind of stay away from these inflation picking up conversations.
I understand that you don't want to be telling the Fed what to do. Obviously, that's not your.
But can I say more abstract, away from the data a little bit, but a broader point that's really important is that when you get a capital spending boom like we have, that's a big increase in supply. And in our models at the CEA, that puts downward pressure on inflation at the margin, because if you have more supply, then you're kicking out down the demand curve. And so we think that the fact that growth is coming from capital spending as opposed to a big surge in consumption is really quite relevant.
Just a finer point on inflation, though. Obviously, this is not something of you getting into telling the Fed what to do, but to do your job, you have to be looking to threats to the economy. Inflation would be one of those threats. What are the places that you watch very closely as an economist to try and just know what the impact would be for the broader economy?
Right. Well. So I look at the PCE deflator. I look at wages. Wages have picked up a little bit over the last 3 months. They're growing at about an annual rate of 4%, which is significantly higher than we saw last year. So there are a number of indicators that the economy is strengthening. Now, again, if the wage growth happens because productivity growth is out there, then that suggests that the models are working the way that we expect. But it's something to keep an eye on. And again, we absolutely are constantly monitoring risks to the forecast. And the biggest risk right now is that the stress in places like Turkey and Venezuela, and to a lesser extent Argentina, and of course China, is going to lead to the emerging markets to sort of head into a direction that's more extremely south than we've seen so far. One of the things about the emerging markets, and that can come back and haunt the U.S. a little bit, is that people tend to, when they get nervous about it, they'll ditch the asset class. And so even countries that are doing great can find all of a sudden that there's a big reduced demand for their bonds. And so that's the kind of thing we're watching out for.
At what point, though, Kevin, do you start to get concerned about the emerging markets' impact on the United States. And specifically, when you take a look at the Chinese stock market, that market is, in bear market territory effectively,
It sure is,
and it has been for a long time. 11% of S&P 500 revenues come from the Asia-Pacific region. To bring back the example of PPG, part of their warning was a slowdown in China specifically. Just because it's happening in China doesn't mean there's no impact here on U.S. companies. So
sure.
How does that plug into your model?
No, you exactly nailed the numbers. That's about the way that I've been briefed about it. The thing is, though, that again, if China comes to the table, and as is the case with the USMCA, where we've got this great deal with Mexico and Canada, we've got a lot of progress with Europe, we've got a closed deal with Korea. So basically, if something like that happens with China, then everything in China is going to turn on a dime. And we're hopeful that that's the scenario that people should keep in mind.
That sounds like a bargaining chip to say to the Chinese. I mean, that doesn't sound like a bargaining chip for the Chinese, because this is something that we here in the United States should be concerned about. If you told any S&P 500 company that 11% of your revenues could be on the table, I'm sure many of the CEOs would say, you know what, we, the U.S., need to get back to the bargaining table and make this work. Do you feel that, does the administration feel that urgency?
Yeah, I mean, absolutely. We've had urgency about the China situation from the beginning. We can see clearly the behaviors that we'd like to have change, and the Chinese understand what that is. And so we're hoping that we can move forward with that. There's one last thing about China that you might recall when we were talking about the tax cuts, last year. Then we were saying, well, actually, since capital is mobile in the U.S. but labor is not, then it's labor that bears the corporate tax, and so we should expect to see wages go up this year, which we're starting to see. Well, in China, it's kind of the reverse. Capital's not really so mobile, and so if you put a tariff on China, then you're hitting their stock market, you're hitting the immobile capital, and that's something that we're seeing really strongly in the data. And I think that puts a lot of pressure on them, because labor is more mobile than capital probably for China.
What else is your data and your models that you've mentioned telling you about what the actual growth rate in China is going to be this year? Put the stock market aside, do you think their underlying economy is hurting a lot more than they're letting on?
I face their data with a lot of skepticism, and there are things we can do to try to noodle through what's going on, but I can't talk necessarily about that. But I think China's looking their data don't seem to vary as much as the other indicators suggest they should.
To what extent do you think they are concerned or optimistic about the fact that you've made trade deals with some of the other countries you've already mentioned?
Well, I would hope that would bring them to the table, but they've got a lot farther to move. I came into this administration as the globalist, right? And when I started to look at the data, at the misbehavior, really, of the Chinese towards the U.S., then we documented things like they're stealing 1% to 3% of our GDP through intellectual property theft every year, right? And so they've got a lot of behaviors that really need to change, and that's way, way farther to go than other developed nations, which has really been partly our point, that China needs to stand up and become a grown-up member of the WTO, a grown-up member of the Club of Developed Nations, and stop doing things like forced technology transfer and the rest.
Do you view the decline in the Chinese stock market, Kevin, as gaining an upper hand or strengthening the upper hand of the United States? You made it sound that way, that the pressure that they're feeling will drive them to the bargaining table. So at the White House, do you see the decline in Shanghai, the decline in Hong Kong, and you think, you know what, that's better for us?
I'm not a negotiator, and I can tell you my wife doesn't even let me near the checkbook, right? So I'm not involved in the negotiations. But if it were me and I were looking at the harm to equity prices and so on that was coming from their intransigence, then I'd be thinking twice about their current position.
Kevin, I want to broach this next question carefully because, again, I don't want to put you in a position where you have to talk about something that is kind of outside your purview. Steven Mnuchin, Treasury Secretary, has said that he is concerned about the yuan's decline. It's been falling pretty rapidly even this week in a couple of step cases. And his concern is that if this is something China is doing intentionally as a way to kind of make their exports more attractive relative to what you see happening in the United States. If the dollar strengthens, yuan falls, you know how that happens. Mm-hmm. I won't ask you to get into the negotiation on this point, but just in terms of how you look at the dollar and the dollar's strength, what that means for your economic forecast next year.
Right. Well, I think that First Secretary Mnuchin is all over this, and he's got an astonishingly gifted team of career people and new people like David Malpass that know everything about currencies that follow this stuff. And as an economist, the one thing I can say is that if you come up with your best model of the currency, then there's a big standard error around about what the right value is at any point in time. And if you're going to make the case for manipulation, then you'd want to show that the currency had moved outside of that bound. Frankly, that's a big test because currencies are so noisy.
But just in terms of how the dollar figures into your forecast for next year?
Well, the strong dollar is definitely part of the strong U.S. economy. I think that American investors are throwing their money at the U.S. economy because they're optimistic about President Trump's policies, and foreign investors are as well. And so that does put upward pressure on the dollar.
Does the U.S. ultimately want the Chinese currency to be free floating? Because if it was, it would be significantly weaker than where it is now.
I'll let our current position on currency policy be Treasury Mnuchin's place. But I think that, we like market determined just about everything.
Kevin, to switch things back to the U.S., what do you make of the strength in oil prices of late, and whether that's going to weigh on economic activity moving forward?
Yeah, I think that when you guys were asking me to think about risks, then that certainly is a risk to the outlook, because one of the things that you notice in the history of oil prices is that there's kind of a nonlinearity, that when economic growth around the world gets high enough, then all of a sudden you jump to a pretty high level. And there's a risk that we're in that nonlinear portion of the curve right now. And if global GDP, doesn't follow the IMF forecast, but rather, recovers quicker, then that could put a lot of upward pressure on oil prices. Now, we've carefully modeled the impact of oil prices on the U.S. economy. And the interesting thing is that the negative effect that used to be a big deal is much less of a big deal because we're such a big oil producer now. So we get a positive effect from higher oil prices and a negative effect, of course, for higher gas prices and so on. And those two effects, almost cancel now. It's been a really big change.
Have you modeled the effects of higher interest rates on the economy, and at what level do you think it does start to weigh on the GDP growth that you can expect?
We've got a big model with 200-something variables that we follow, and right now, the interest rates that are consistent with our growth forecast are about consistent with the Fed forward guidance and with the CBO's long-run forecast.
Kevin, most economists will say that the economy is very strong, but they take a look at two sectors and how they have really failed to grow this year, autos and housing, and they think that maybe that's trouble underneath the hood. Since the 60s, they were a fairly stable percentage of GDP, but in the first and second quarters, they failed to maintain their percentage of GDP, and they've actually been shrinking, and that's causing some concern, maybe showing signs of stress by the consumer, who are facing higher costs from everything from higher interest rates to higher oil prices. How do you look at that? Are those no longer good indicators of the economy, or is there some sort of disconnect going on?
Well, they're both important indicators. Let's take them one at a time. Now, in autos, I think one of the interesting things that we're seeing is just that the cars have such high quality that they kind of last forever, and so that the turnover rate has gone down over time. People can drive their cars longer. Used to be the car would wear out and you had to buy a new one at a relatively high rate. And so I think that it's possible that we're sort of level adjusting to a new share of autos and GDP. On the housing side, one of the things that very often precedes a recession is that you get a big housing boom after real estate prices skyrocket, and then that housing boom drives real estate prices down because there's a big increase in supply, and that puts a lot of pressure on lenders. And so I think that if you're thinking about, does this recovery have legs, then having housing moving a little bit slower than it did the last time we were booming like this before the last Great Recession is probably something of a comforting thought.
Kevin, we've asked you a lot of questions about potential threats to the economy, things that could surprise to the downside. But last question, is there anything that you think could potentially surprise to the upside and lead to a better economy next year than you're anticipating?
Yeah, I think that absolutely there are a lot of things that could surprise on the upside. But one of the big things is policy. President Trump has a really aggressive agenda that he talked about all the way back to the campaign, and we're not done. We've got deregulation that we can keep doing, and we've also got an infrastructure plan, for example, that we were hoping that we could move this year, but I'm sure that President Trump and the team will think about whether next year is a better time. But if that big $1 trillion infrastructure project were to go through, then that again increases the quality of capital of the U.S. It could be a big positive for the economy,
all right,
even
Kevin,
this late in the cycle.
It's always great to see you. We appreciate your time
Thanks
today.
for having me. Yep,
Kevin
bye-bye.
Hassett again is the chairman of the Council of Economic Advisors.